This aspect of revenue recognition is addressing the problem that all builders face. And you can see examples of this throughout Manchester, these tall multi-story buildings going up all over the place. How is it financed? Do the builders have to pay all the cost, all the wages for 2 years and then get payment at the end? If they did that, they would go bust because they would have to do an awful lot of borrowing against the revenue. So that is only a promise. Normally, therefore, payments are made as the contract reaches certain stages, however it's agreed. And in this case, we look at two basic ways in which payment can be made. Either it can be made on the basis of the progress of costs, or it can be made on the basis of work certified. Looking at this particular question, Castle enters into a contract with a customer to construct a specialised building for £10 million. Castle is not able to use the building at any point during the construction. Castle has incurred costs of £6 million and costs to complete are £2 million. Castle decides to measure the progress towards completion based on costs incurred. So it says this is a decision by Castle. It's then up to the professional accountant to come along and see whether this is a reasonable basis for working out their profits. To date, Castle has received £3 million from the customer. So how should this transaction be accounted for in the year ended 31st of December 2001? The first thing to point out is the overall structure of our reply, and that is, what is the overall contract position? What is our progress through this contract? And then how do we make our entries into the statement of profit or loss and lower down the statement of financial position? This is the common format. So to answer this type of question, you need to learn the format and then fill in the figures as you go along. And there are little innovations in each question that you need to be aware of, and if you just practice these questions a couple of times, you shouldn't find them too difficult. In this answer, we've got the costs to completion are 2 million. Well, I'll call it 2,000, right? So we've got 2,000 cost to completion. The overall position is this. The price of the contract is 10 million. That's the potential revenue at the end of the period when it's constructed. Costs to date are 6,000. Cost to complete are 2,000. So overall, we're looking at a profit of 2,000. What is our progress through this contract? Well, our costs to date are 6,000. Total costs are 8,000. That is the 6 plus the 2. And therefore, we're 75% through the contract. 6 divided by 8. We're 3/4 of the way through the contract. So what we do is, very simply, we take revenue as being 3/4 of our total revenue and costs as being 3/4 of our total costs. So a very simple approach, but we don't really have enough information to do anything more detailed than that. Revenue, therefore, is 3/4 of the 10,000, and our costs are 3/4 of our total costs of 8,000, which, because it's based on cost, is going to be the cost we've spent so far. So that gives us a profit so far of 1,500. So the building firm would be asking the accountants whether this is a reasonable estimate of the profitability so far. Certainly it would be unfair to say, well, you've not received any, or you've only received 3 million, and therefore we should count that and then take off the 6 million, you're making a loss of 3 million. That's a bit harsh. We want to reflect the true nature of the situation. They're 3/4 of the way through, 3/4 of the revenue, 3/4 of the costs, measuring our progress as a cost base. When we look at the current assets, we can see that the receivables, our sales value is 7,500. They've paid 3,000, so we are technically owed 4,500. If everything came to an end at that point, this is the kind of claim that the building firm would be taking to court, as being a reasonable estimate. There are no other items involved because all the costs incurred, all the cost to date has gone out as cost of sales. So there's no stock or anything like that. Now we're going to look at a variation on this question, and we're going to say that the costs to complete is 6,000, not the 2,000, or taking note of that it's in thousands, it's 6 million, not the 2 million in the question. Right, so it's 2 million in the question, but we're going to have a look at the situation if it was 6 million. So the figure cost to completion is 6 million. We've got our existing method and we apply it to this question and we get a slight innovation that's worth noting. So our price is the same as before, it's 10 million or 10,000. And our cost to complete is now 6,000. So the difference here is that we are looking at making a loss, and that is not an uncommon thing in such construction contracts. What happens if we make a loss? Well, as your lecture notes will show, it's loss making. Castle must provide for the full loss immediately. And that is part of the conservatism of accounting. If there is a loss in prospect, then, well, it does vary on the circumstances. Sometimes it's a note in the accounts, but in this case, we need to provide for that loss. So that's our overall position. Now we look at the progress, just as we did before. Costs to date are 6,000. Total cost this time is the two 6,000s added up together, so that's 12,000. And we're 50% this time through the contract, not 75%. So we apply this 50% to our overall revenue of 10,000. 50% of 10,000 is 5,000. Our cost of sales is based on the cost, 50% of our total costs. So 50% of that, which is 6,000, which is of course also the amount we've actually spent. That in prospect is revenue 5,000, cost 6,000, deficit 1,000. But we know the overall position is a deficit of 2,000. So we need to provide for that loss, and we do so using much the same technique as with depreciation. We put a charge in of 1,000 and we credit a provision account of by 1,000. And so that means that our statement of profit or loss comes out with a loss of 2,000, recognizing the full 2,000 loss of our overall position. So that's an important innovation. Now we move to the statements of financial position. Our receivables are 2,000, and just take that out. And that is 5,000, that's our revenue. See if I can, yes, I just spread that out a bit. So 2,000, which is our revenue minus what we've been paid. So 5,000 minus 3,000. As we're only halfway through the contract, it is 5,000. And but we still got the 3,000 payment. That's fact. So that's 2,000 that we're owed. And then the credit side of the provision, credit provision, debit cost of sales. Our debit cost of sales is there. Our credit to the provision account is there, and that's going to appear in the statement of financial position. Looking at the two solutions together, we started out by looking at cost of completion as being 2,000, and then we looked at the situation if those cost of completion were to be 6,000. Looking at the two together, we can see what a huge difference it makes to the profit and loss and to the progress of the contract and to its subsequent treatment. So it is critical, the measurement as to how far we have got through the contract. And basing it on costs is one approach. As we shall see in the next question, it can also be based on work certified, which is the other approach.